All right. Today we're talking about chart patterns, or rather, breakout chart patterns. When the market moves, the market creates patterns when it moves. Every movement in the market is never a random movement. These are moves that most of the times have been preempted, and this movement in the market over time have created some pattern. And whenever these patterns are being observed, whenever these patterns present themselves, they actually provide good opportunity for one to take some wonderful trade. They actually provide some good trade setups. Most of these patterns can actually be seen on any time frame at all. Now, there are a lot of these patterns, but the ones we're going to be looking at, we're going to be looking at the double top and double bottom, the head and shoulders and inverse head and shoulder. Then we'll look at the rectangles. Though there are a whole lot of other patterns, but these are the ones we're going to be looking at in the context of this class tonight. So I'll be doing more of, I'll be explaining more, making use of the charts. I'm not reading out from the slide. Okay, now the first one's going to be looking at the double top and the double bottom. Now, the double top is a chart pattern that is formed after an extensive movement up. After an extensive movement up, when price has done a movement up, it forms a double top. Now, the price made a movement from down to this top, and when it got to this particular when it got to this particular area here, it moved up to this particular top here, created this high. When it created this high, price returned back down. It returned back down, then went back up again. Went back up again to the same price area as the previous high that has been created. Then afterwards, started to make its way down. Now, whenever you notice a chart movement like this, I'll just draw it up. A chart movement like this that was issued after an extent, after price have made quite a move up. If I notice a chart movement like this, a market creating this top, a top like this, another top like this, a pattern that looks more like an M. This is your double top. Whenever you spot out a chart pattern like this, all you need to do is to identify the neckline. Neckline is the center that was created when price made its way down. When we identify the neckline, you are waiting for a candlestick to close below the neckline. You're waiting for a candlestick to close below the neckline. Now, a candlestick closing below the neckline is what determines or what validates your entry, in this case, for a sell. Because the double top is a pattern that issues a bearish reversal. It's a pattern that issues a bearish reversal. Whenever you spot the double top chart pattern, it simply means that the market is about to reverse to go down. And of course, you need to find your point of entry. Where is your point of entry? The point of entry is at the close of a candlestick below the neckline. The close of the candlestick below the neckline. Now, looking using the chart example we have here, this is the candlestick that closed below the neckline. And that is why we'll have the sell at that point. Having the sell at that point, you can actually use any high above the neckline as your stop loss. Now, for the take profit, I do tell people that irrespective of the fact that most times price setup or chart setup will always present to you the right point for you to put your, or for you to have your take profit. But take profit is always at once discretion. It's always at the trader's discretion. But when you are trading breakout chart pattern, they have their rules. There are rules for take profit. Now, how do you take your mark out your area of take profit, judging by the rule of chart pattern? When you measure the number of pips, from the top of the double top pattern, from the top to the neckline, the number of pips from the top to the neckline, take the same number of pips from when the market breaks the neckline, from the neckline down. Price will make the same number of pips downwards before any form of reversal is being issued. Now, if you check this from the top of the double top chart pattern to the neckline, we have about 32 pips. You have three values there. You have zero, the first digit, which is the number of candlesticks from where the point you are measured from. Then we have 329. The 329 there is the number of pips. You put a decimal point before the last digit, which is 32.9 pips. So roughly 32 pips. Then the price there, the 1.14494 is actually the price on that area. So from the top to the neckline is 32 pips. Now you measure the same number of pips from the neckline downwards. To wherever you have 32 pips, you use the same area or the same point as your take profit. But I do tell people that when it comes to take profit, it's always at one's discretion. But if you are trading with the rule of breakout chart patterns, this is how you take your profit. Take the measurement from the top to the neckline, take the same number of pips on the neckline downwards, and use that as your take profit. That is it for the double top. This is a pattern that is being formed at the top of an uptrend. And if it so happens that this is forming at the area where you already have your horizontal line serving as either support resistance, then it gives you more confirmed entry. At that point, you have a confluence of signal. Though they can actually form anywhere on the chart, but if they are forming at the area where you have your horizontal line serving as either your support or your resistance line, then these areas actually holds more value, actually an area of interest. And whenever you spot out the double top forming, just identify where you have your neckline, then wait for the close of the candlestick below the neckline. Now the next chart pattern is your double bottom. The double bottom is the inverse or the opposite of the double top. It's the opposite of the double top. The double bottom is formed after an extensive movement down. That price has made the move down. From this chart pattern here, you can see price made the movement down from top to this bottom. And when it got to this bottom, at that point, you have no idea the pattern is being created. Price made its way up again, made its way up, return back down. Return back down. At this point, you probably might think, okay, this is still going to have a continuous downtrend. But it didn't continue the movement down. It maintained the low just as the previous one. Then at the point is making its way up here, it gives you the idea that a double bottom has just been formed. What do? You simply identify the neckline. That's what a double bottom looks like. It looks more like a W. You identify the neckline. I'm waiting for a candlestick. In this case, it has to be, of course, it has to be a bullish candlestick because the double bottom reverses the market to go bullish.
Okay.
It's a bullish reversal chart pattern, the double bottom. The double top issues a bearish reversal, whereas the double bottom issues a bullish reversal. So waiting for the candlestick to close above the neckline. Now in this instance, this is a candlestick that rightly close above the neckline. That is why you have the buy at that point. That's why you have the buy there at the close of that candlestick. That validates the entry for a buy with the formation of the double bottom pattern. Then use the recent low below the neckline as your stop loss. That's why I have the stop loss right at that point. Then for your take profit, just like the double top, take the number of pips. Measure the number of pips from the bottom to the neckline. This is about 40 pips. About 40 pips. Measure the same 40 pips from the neckline above. The same 40 pips from the neckline above, and use that area, the price at that point. You can use that price at that point as your take profit. So this price here, 1.17440. That's the price you should use for your take profit, because price will always make the same number of pips from the bottom to the neckline. It's going to make the same number of pips when it breaks the neckline before whatever reversal is being issued. So the double top reverses the market to go bearish. Double bottom issues a bullish reversal. The double top is formed after an extensive movement up, which looks more like an M. The double bottom is formed after an extensive movement down, which looks more like a W pattern. The next chart pattern are the heads and shoulders. Every chart, every pattern, candlestick, chart pattern, whichever one has that for the bullish and that for the bearish. So the next chart pattern is your head and shoulder. Now your head and shoulder pattern is a pattern that is being formed also after an extensive movement up. Now this is what a head and shoulder pattern looks like. Price makes an extensive movement up, forms a high. At this point, this is the highest high you could find, you could spot out. Then makes a movement down, which could be seen to be a lower high, creates another higher high, which is a continuous uptrend. At this point, you have no idea of what is about to be formed. This simply shows you a continuous uptrend. You have a higher high, then price makes another low. Price makes another low, then returns up, creates another high. Now this high is not up to the same price area as the second high. It's not up to the same price area as the second high. This is your shoulder. This is your second shoulder. And this is the head.
Okay.
So this gives you your head and shoulder chart pattern. Now this head and shoulder is a very strong bearish reversal chart pattern. Just like the double top and double bottom, you identify your neckline.
Okay.
You identify your neckline, you have to wait for a candlestick to close below the neckline. The head and shoulder is a bearish reversal chart pattern. Of course, it has to be a bearish candlestick that will close below the neckline. Now, when I say close below the neckline, let me make something clear. This is not a close below the neckline.
Okay.
The candlestick did not close below the neckline. So this will not be seen as a close below the neckline. This is what I mean by a close. When the body of the candlestick closes below the neckline.
Okay.
So that we don't mistake the fact that because the candlestick initially, before it closed, it went below the neckline, but before it was closed, it came and closed above it, leaving a wick below. That is not what I mean by a close. The first one is not a close. This is not a close below the neckline. That is not a close. This is a close below the neckline.
Okay.
So the close below the neckline confirms your entry for a sell. Just like the chart example, you have price initially made a high. Price initially made a high. Return back low, create a higher high. The higher high came down, then another high that is not up to the second high. Now, the two shoulders may not be on the same price level. But whichever the case, the two shoulders will not get to the price area of the head. This is your head and shoulder. It's a very strong bearish reversal chart pattern. Whenever you spot it out, identify your neckline, wait for the close, and wait for the close below the neckline to confirm your entry for yourself. Now, in this case, this is the candlestick that closed below the neckline. That is a candlestick that closed below the neckline. That's why I have the sell there. Then the closest high before the neckline was used as just stop loss. Now this is the area. This is your stop loss. The stop loss was actually placed here, which is where the pattern presented for the stop loss. Now, even when you enter the market for a sell, when you enter the market for a sell right at this point, it didn't actually proceed low, but proceed to go short immediately. The market did a pullback, went down a bit, couple of pips, and did a pullback back up. When they pull back up, at this point, we are obviously in some negative positions of about, let's say, probably having about 22 pips negative when this happened, but the trade was still valid because we had a point where the stop loss was not taken out before the market reversed to come down. So we had the stop loss was actually not hit, even though that trade might have been negative, but it was still valid at that point because the stop loss was not taken out. And for the take profit, just like every other chart pattern, you measure the number of pips from the head to the neckline. Here gives us about 35 pips to approximate it. Take the same number of pips from the neckline down. Whenever you have 35 pips, use the price there as your take profit. Like I said, price will always make the same number of pips from the head to the neckline. It's going to make the same number of pips when it breaks the neckline before any reversal is being issued. Now that is the rule for trading chart patterns. That is the head and shoulder. Now we also have the inverse head and shoulder. The inverse head and shoulder is the opposite of the head and shoulder chart pattern. Now the head and shoulder is formed at the top of the uptrend, whereas the inverse head and shoulder is formed at the bottom of the downtrend. Price made a move down. At the end of that move down, it created a low, returned back at a higher low, then created a low, another lower low, which is seen to be a continuous downtrend, made this way up again. It made this way up, then came down, created a low, but this low is not, didn't get to the same price area as the second low. At this point, what you have here is an inverse head and shoulder. Identify a neckline. Now note that your two shoulders definitely may not be on the same price area, and also your neckline may not be horizontal.
Okay.
It may not be horizontal. That is why I drew this instance here. The neckline here is not horizontal. That is why I drew this. The neckline may not be horizontal. So we're waiting for the candlestick. Now the inverse head and shoulder gives a bullish reversal. So we're waiting, of course, there has to be a bullish candlestick that will close above the neckline, confirms your entry for a buy. Then for take profits, take the number of pips from the head to the neckline. From the head to the neckline, now let's all have here, this is about 49 pips on the average. Take the same number of pips from the neckline up, and use the price there as your take profit, as your take profit price. Yeah. Now, I said something earlier that whatever chart setup that presents itself will always present where your take profit is meant to be. Now, if you look at this chart, this what we have here, this is what is called a period separator. These dotted vertical lines. From here to here represents 1 day, 24 hours. This is a 1 hour time frame. From here to here represents another 24 hours. From here to here represents 24 hours. From here to here represents another 24 hours. Right now, let me highlight this to be, let's say, okay, let me say this is I have Monday here. This is Tuesday, for instance.
Okay.
This is Wednesday. This is Thursday. This is Friday. Okay. Now, the head and the advanced head and shoulder started. The first shoulder was formed on Monday. Second shoulder on Tuesday. The head on Tuesday. Second shoulder was formed between Monday and Tuesday. Then between Tuesday and Wednesday. Then the entry was formed towards the middle of the day on Wednesday. Now you bought on that Wednesday. Now using the rule of take profit for chart patterns, you're definitely going to take your profit on that same Wednesday. I think the profit point was actually gotten on the next. Okay, let's do this. This was the candle that you bought on. You bought on this candle. After that, we'll have this and that candle 1 hour. Then the second candle. This is the third one. And this is the fourth candle. So in 4 hours, 4 candles is 4 hours, 1 hour each. So in 4 hours, you've already hit your profit target in 4 hours using the rule of law for breakout chart pattern. But if I'm the one taking this trade, I will not have my take profit at the point where I have the 49 pips. Every chart pattern presents where the take profit is meant to be. If I'm not taking this trade, this is where I'm going to use for my take profit. I'll be taking my profit, targeting this price here. Now, why will I use the price on that high? That was where the price left before it came down to form the reversal pattern that was issued. Price making its way back up, that is the same price is returning to. That is the same area it is getting to before it could do any major reversal. So that is actually where I would have taken my profit on. If I have my entry for buy here, I'm going to use the price here is let's say about my price is 1.13002. This is about 106 pips. So I'll be going for about 106 pips profit. Now, but the issue with this is that I'm going to roll over that trade a couple of days because I'm not going to price is not going to hit that particular area that same day. Now, when was the profit taken? The profit was taken on this candle.
Friday.
Profit was taken on this candle, and that was Friday. That was a trade that was taken on Wednesday. Friday afternoon, that was when that profit was hit. If I'm the one taking that trade, that is where I will take my profit on. based on market structure. But if you are trading based on the rules of chart patterns, then you can go with, I can go with the 49 pips profit. So that is it. So that's why I always say that profit taking is always at one's discretion. It's always at the trader's discretion. All right. So I've talked about double top and double bottom, head and shoulders. Any question?
No, sir. It's quite clear.
All right. So the next chart pattern I'll be talking about here is the rectangle chart pattern. The rectangles. Now, the rectangle chart pattern, this is a pattern that is being formed when price is bounded between a parallel support and resistance. When price is being bounded between a parallel support and resistance levels. Rectangle chart patterns are more of continuation chart pattern. A trend is already in motion. It's a pattern that is being used to join in on an already existing trend. It's a pattern that's used to join the market once the market breaks out of its consolidation. The forex market consolidates. Okay, let me not say that. Are you done with the book I asked you to read?
Sir? The candlesticks?
Are you done with the book?
No, not yet.
You're still on.
I'm waiting.
You're still on Dragonfly Doji.
Since I had to go to work yesterday, I'm going to finish it before Salah. Like I have 2 days now, so I'll finish it.
Okay. All right. The forex market consolidates 70% of the time, and it trends only 30%. So when it's trending, it is very, very obvious. Now, this rectangle chart pattern presents both the bullish and the bearish rectangle. The bullish rectangle is formed in the course of an uptrend. The bullish rectangle is formed in the course of an uptrend, whereas the bearish rectangle is formed in the course of a downtrend. Let me give us a chart example. Now, price made a move up from down here. Here's how the movement was done: a higher high, higher low, higher high, higher low. Right, until a reversal was issued with a double top, then it continued down again. This is how the market price move. Now let's start from the bottom and work our way up. Now, when price made the move up, when it made this move up, of course, this gives you an indication that my price is making an uptrend at this point. Now, after this, price started to consolidate. Now, rectangle is formed when consolidation is when the price is bounded between a parallel support and resistance. Now, let me pull out this rectangle. Let me have this rectangle here for me to make my point clear.
Okay.
Now, what are some persons who actually trade breakout chart patterns? They usually target when the market is consolidating, and they look for entries in the course of the breakouts. Now, this is a consolidation that is bounded between two parallel lines above and below, at this point forming a rectangle. What are you looking at for? You're thinking outside the box. We are looking for the market to break out of the box because it's an uptrend. Because it's an uptrend, you're looking for a breakout in the upside. You're looking because it's an uptrend. You're looking for a breakout in the upside because it's an uptrend. All right. Now, In that instance, they're looking for market to break out. Now, when the market broke out, it broke out with this particular candlestick, which at this point gives us a point of entry for a buy. Point of entry for a buy. Now, but what I do tell people is, as a trader, you don't just trade blindly. You always try to trade smartly. All right, it's actually, it pays more to be a smart trader, not just to be a regular or everyday trader. Now, you spotted this pattern forming on your 1 hour time frame. And this particular candlestick that broke out of the rectangle actually took an exactly 1 hour to form. And in the course of that hour, it took a long time for that candlestick to actually close. It's quite a long candle. If I should measure that candlestick, the body, that candlestick is about 46 pips. That's a very long candlestick. Now, instead of me waiting for an hour for this candlestick to close, for me to take that trade on buy, I could actually go to a lower time frame, say 15 minutes. Okay. 15 minutes to see if the markets have broken out of the rectangle. Now look at it here on 15 minutes. On 15 minutes, I would have gotten an entry for a buy here. But I've gotten an entry for a buy at this point on 15 minutes. At this point of 15 minutes, instead of the one above, which I got on 1 hour. Let me see how to identify this point. Okay, this is my entry on H1. And here is my entry on 15 minutes. This is where I would have gotten the entry for a buy on 15 minutes. But let's say I went as low as 5 minutes. I went as low as 5 minutes time frame to look for my entry. Let's see if I would have gotten an entry on 5 minutes. This is that same rectangle of 5 minutes. Okay, on 5 minutes, I would have gotten an entry on 5 minutes here. For 5 minutes, I would have gotten an entry for a buy on 5 minutes at this point, which would have been, if I entered the market on a close above the rectangle on 5 minutes, I would have been in the market I would have made a profit of about 11 to 12 pips before the guys who took a trade on 1 hour did that. Did that, yes. Yeah, so most of the time when looking, once you see your pattern formed or being created, so waiting to take a trade on that probably higher time frame where you spotted that setup, you can actually go to a lower time frame and look for a quicker or a fast entry. And look for a fast entry, all right?
Yes, sir.
All right, back to 1 hour time frame. Price at the point price broke out of that area, I took my entry for a buy. Price went up. It made its way up again. This was when the point of breaking out, it went up. Now, when price went up, it started to form another rectangle above. Started forming another rectangle above. And at this point, I'm also waiting for the breakout above the rectangle, which actually gave me a breakout somewhere around here. Somewhere around here. But before it went up and a top was created. Now the market reversed. And when it got up, When price got up, it reversed to go short. It gave a bearish reversal pattern. Now, what's that bearish reversal pattern? That is your double top. It gave me a double top pattern. A double top pattern, of course, with double top, I have to confirm where my neckline is. I'm waiting for the close below my neckline, which is actually at this point. I sell. Use a high above the neckline for my stop loss. And price makes its way down. Right? If my take profit, I would have, okay, if I measure the number of pips from the top to the neckline, this is about 32 pips. By 2 pips from the neckline, so my stop loss should be, my take profit should be somewhere around here. This would have been where my take profit would have, I had my take profit somewhere around here. Somewhere around here. And that is at the point when price started consolidating. As I consolidated and formed a rectangle. I formed a rectangle in the course of a downtrend. In the course of a downtrend, which is a bearish rectangle. Now waiting for a close on the downside, which it did. It closed on the downside, so I have the sell at that point. You can see my stop loss is. The market, when it closed below that rectangle, out of that rectangle, it proceeded downwards and market starts to consolidate. Now, it consolidated for a long time. It formed a bearish rectangle for quite a long time, which took some couple of days, but afterwards, it was able to break out of it. Breaking out of it, you can see where I have the sell. Stop loss. Price also made its way down. When it got down, it reversed to go back up with an inverse head and shoulder.